Very good morning to all of you students. Today we will be continuing with the topic of business valuations. So students, in our previous session, we have gone through around different ways or different methods of calculating a value for a business, which we broadly classified into three main categories. One was the asset based, second was the income based, and third one was the cash flow based. Okay. So today, students, we will be doing certain questions to form up that understanding, right? And we will be also taking up two or three more concepts that are part of the curriculum. Good morning, Satish, Shailesh, Guram, Viraj. Good morning, everyone. So, yeah, students, let's start with question number 9. Sorry. The valuation of Hansel Limited has been done by an investment analyst based on an expected free cash flow of rupees 54 lakhs for the following year and an expected growth rate of 9%. Students, each and every word we have to place a good amount of emphasis. Good morning, Ansha. So first of all, they are saying that this free cash flow is expected for the following month, for the following year. And the growth rate expected is 9%. So can we say that growth is 9% and free cash flow for the next year is rupees 54 lakhs. Good morning, Mohammed Abdul Rahim. The analyst has estimated the value of Hansel Limited to be 1800 lakhs. Okay, so the value is already determined at 1800 lakhs. However, he committed a mistake of using the book values of debt and equity. However, he made a mistake. Now, since we're talking about the value from the market perspective, hence for debt and equity, we need to take the not the book value, but the market value, right? Good morning, Shruti. So, in a way, where is this debt and equity book value would have been used by that investment analysis? Can we understand or can we think of that where we would have used such debt and equity book values? It would have been used in the cost of capital, correct? So cost of capital, which is let's say overall cost of capital, as we say, or WACC, as we say, right? So this type of valuation we have not studied till now, right? However, can we apply the principles that we have studied earlier? Yes. How can we apply that? Value is equal to discounted free cash flow, discounted free cash flow divided by cost of capital minus growth. This will not be discounted. This is just a free cash flow. Okay. So free cash flow divided by cost of capital minus growth. Okay, students. The book value of weights employed by the analyst are not known. But you know that Hansel Limited has a cost of equity 20% and post-tax cost of debt is 10%, students. So this is another piece of information that they have given. They are saying 20% is cost of equity and 10% is equal to cost of debt and that to post-tax. So students, tell me, for your WACC calculation, do you need post-tax numbers? Yes, at least for debt. And is the number given post-tax? Yes. So For calculating the overall cost of capital, now we have the percentages. The only thing that we don't have is the correct weight for debt and equity. The investment analyst has already used some weights, but those weights are basis the book value, which we don't want to use because the cost of capital should be calculated by using the market value, or let's say the market proportion of equity and debt both. Okay. The value of equity is thrice its book value, whereas the market value of its debt is 9/10 of the book value. That also they have given. So, so what they are saying is the correct book value, sorry, the correct value of equity is 3 times book value, correct? And so this is value for equity, and similarly value for debt is equal to 9/10 of book value of debt. Understood? This is clear, students? This is a bit tricky question, and hence we have to be really careful while solving it. Now they are asking what is the correct value of Hensel Limited. So in a way, they are asking us that if you use these correct weights to compute yeah. So if you use these correct weights to calculate overall cost of capital, using that you calculate the revised value of Hensel Limited. This is what the problem is, correct? Or let's say this is what the question is. I hope this is understood, students. So once we know that what is actually needed in the question, we can actually solve it basis the step-by-step approach. Okay. So how we can arrive at the overall cost of capital? For that, we need to first know that what are the right book values. Now, for calculating the right book values, we need to calculate what is the overall cost of capital as of today, as of the wrong calculation, right? That we need to calculate. So let's start, students. Solution. We can just simply write the formula business valuation is equal to free cash flow divided by overall of cost of capital minus growth. So KC, we can say overall cost of capital, G is equal to growth. Correct? Now, business valuation is given to us at the first place is 1800 lakhs. Okay. So 1800 lakhs is equal to free cash flow is how much? 54 lakhs divided by overall cost of capital minus growth is how much? 9%. Okay. Growth is 9%, students. So if we substitute these things, then it becomes 54 divided by 1800, which is 3% plus 9%. So in totality, it is 12%. So the overall cost of capital is coming out to be 12%, students. Okay. Overall cost of capital is coming out to be 12%. Now within this has been calculated by the investment analyst using the book values, correct? So can we say that overall cost of capital is equal to cost of equity multiplied by equity divided by equity plus debt. Okay. Plus cost of debt multiplied by debt divided by equity plus debt. Okay. And can we simplify this? Let the proportion of debt be X. So this will get revised to KE into 1 minus X plus KD into X. KD into X. Correct? Because debt plus equity will always be equal to 1, students. So that is why we have used this relationship to arrive at single value, single variable equation, right? Now this is 12% is equal to 20% is the cost of equity, 1 minus X plus 10% is post-tax cost of debt into X. Okay, students. So by solving this, X is actually 20%. X is actually, sorry, 80%, students. So hence, book value are as follows. Equity, debt. Equity is how much? 20%. So that means whatever that amount is. Let's say we will say that 0.20. Similarly, debt is 80%, 0.80. We have not been given the absolute amounts, right, of the capital invested. So we can just work on the proportions. Okay. So 0.20 and 0.80. Corrected book values. Sorry, corrected values to be used for valuation is as follows. So for equity, this will be 3 times 0.20, right? So this becomes 0.60. For debt, it will be 9 by 10th times of 0.80, correct? Which becomes 0.72, students. I hope this is clear. So the revised weights of equity and debt become 0.60 and 0.72. Basis this, the cost of capital comes out to be 20% on 0.60 divided by 0.60 plus 0.72. Correct? So equity plus debt in put together, carrying out the equity related value on 20% plus post-tax cost of debt is 10% multiplied by 0.72 divided by 0.60 plus 0.72, students. So the revised cost of capital will be 14.5455 percentage. Okay. And hence, revised value, sorry, will become 54 lakhs divided by 14.5455% minus 9%. So this becomes rupees 974.73 lakhs. This is the revised value. Understood? So from 1800 rupees, this has gone down to 974.73. Couple of questions. Shruti, yes, this is a very good question. Shruti is asking, but sir, you told that debt and equity is one. Yes, I told you that because we are talking here about proportions, Shruti. Okay. We started with 0.20 and 0.80 as one, which we have assumed that the person who has calculated the workings would have also assumed the same. However, these were not the right values. The right values is 3 times of this and 9.10 times of this. Now, the moment you do 0.60 plus 0.72, this is equated to 1. The total is coming out to be 1.32. That I understand. But if you see in the debt plus equity, okay, if you calculate this proportion, what is this proportion? 0.60 divided by 1.32. This comes out to be 0.45. Wait, 45.45%. Okay. And that one, if you calculate 72 divided by 1.32, this actually comes up as 54.54 percentage. This will be actually 45.46. Okay. Because we have to round it up. So if you take a total of this 54.54 plus 45.46, it comes as 100%. Still, that equation is holding true, Shruti. Okay. As I told you, if you solve this plus this will again be equal to 1 or 100%. Reason being, here we have just taken the relative values, the relative correct values. That is why you are able to see 1.32. Okay. Guram is saying, sir, what is the off-balance sheet item like off-balance sheet finance, etc.? Okay, Guram. So, Guram, have you heard about the trade financing? Let's say the receivables discounting, the bill discounting for receivables. Similarly, the payables part, you do a payables delayed payment. Okay, let's say your normal regular payment terms for the trade payables is, let's say, 30 days. You enter into a agreement with the bank saying that bank will pay to the vendor on 30th day, which does not comes into your balance sheet. Similarly, your trade receivables is due to be collected on 30th day. But today you go to the bank and present it for the purpose of discounting. On day one itself, you get, let's say, 99% of the entire receivable because 1% bank will keep. So that 99% funds that you have realized today, don't you think that you have preponed your collection and hence it is a off balance sheet finance? Okay. So these are some of the examples, Guram, on trade payables, trade receivables. Okay, Satish, thank you. Any other questions, students? Should we move ahead? This question was having only one trick point, which was to calculate the revised cost of capital, right? Let's come to question number 10, students. With the help of following information of Jatayu Limited, compute the economic value added. Just a second, students. Yes, perfect. So with the help of the following information of Jatayu Limited, compute the economic value added. They are asking us to calculate the EVA. Capital structure is they have a equity capital of 160 lakhs. They have a reserves and surplus of 140 lakhs. Now tell me, students, these reserves and surplus should form part of whom? Equity or debt or both? Tell me, students. So tell me, the reserves and surplus you will consider as for the equity or debt or both, because it is related to the overall value of the company. How will you relate it, students? Tell me. Very good. Kirti, Guram, Shailesh, Kusuma, Satish, Prashant, Mansha, all of you are correct. We always say reserves and surplus is part of equity. Okay. So don't ever write or let's say include for any calculation purposes these amounts in debt. Okay. Always take it for equity. 10% debentures are at 400 lakhs. Cost of equity is 14%. Financial leverage is 1.5 times. Income tax rate is 30%. Yes, Shruti and Rahim, it's equity. Now, tell me, students, one thing. What do you mean by financial leverage? What is exactly meant by financial leverage? Yes, students, tell me, what do you mean by financial leverage? Okay, so meanwhile, Guram is saying that, but debtors are also part of balance sheet. Yes, Guram, I'm not denying that. But the financing is an off balance sheet financing. Okay, the financing is an off balance sheet financing, wherein it will not come into your balance sheet as a loan, right? That is why it is called as off balance sheet. Okay, I've got multiple responses. Shailesh, good. You are right. Mansha, you are right. Um, Abdul Rahim, you are also right. Kusuma, please check once what you have written. So financial leverage is not that. Financial leverage is Guram. Yes, you're also right. Kirti, you're also right. Perfect. I think all of you know this. Very good. I need not explain this then. So financial leverage is actually PBIT divided by PBT. So for 1 rupee of profit before tax, how much is our profit before interest and tax? That means the extra amount of interest that we have. Correct? So let's start with the financial leverage first. So they have told us that it is 1.5 times. So it becomes PBIT divided by PBT, correct? Now for PBT, can I say that PBT is equal to PBIT minus interest? Yes. So 1.5 times translates to 1.5 times translates to PBIT here divided by PBIT minus interest, correct? As PBT is equal to PBIT minus interest, students. Okay. Now, in a way, 1.5 times into PBIT minus, can we say what is the interest? On 400 lakhs, 10% is the amount. That means 40 lakhs is the interest, right? PBIT, correct? Correct. Now, this becomes 1.5 times PBIT minus 60 lakhs is equal to PBIT. So 0.5 times of PBIT is equal to 60 lakhs. And hence PBIT becomes 60 divided by 0.5, which is 120 lakhs. So PBIT becomes 120 lakhs, students. Profit before interest and tax. Now, if you note that we have to calculate the EVA, economic value added. What was the formula of EVA, students? It was net operating profit after tax minus capital charge. Correct? Now, this was given as, we can say PBIT because we are using the word PBIT here. 1 minus tax minus capital charge. So in current context, what is the PBIT? 120 lakhs. What is the tax rate? I think 30%. Yes. 0.30 minus capital charge. For capital charge, we need WACC, right? Okay, let's do it like this. WACC into capital employed. So here, let us calculate WACC. On the next page, let me calculate WACC. Calculation of weighted average cost of capital. Okay. So weighted average cost of capital will be, what is the cost of equity? Cost of equity is 14% on what is the proportion 160 plus 140, which is 300 lakhs divided by 700 lakhs plus 10% debentures of 400 lakhs. Now, students, I have done one mistake here. I want all of you to find out that. What is that mistake, students? Come on, tell me. So for calculating WACC, I have done a mistake. This will not give us the right WACC, students. What should we correct here to arrive at the right WACC? Yes, Mansha and Abdul Rahim have given their answers and they are correct. But I request others also to please answer. What should be the correction in the calculation of WACC, students? Yes, Gurram, Satish, Shailesh, Kusuma, Prashant, Kirti. Yes, all of you are correct. Very good. 1 minus 0.30. So cost of debt has to be post tax. Correct? Now this will come as how much? This is coming out to be 0.14 into 3 divided by 7. Then 0.07 into 4 divided by 7. This is coming out to be 10%. So finally now EVA can be rewritten as from 120 lakhs. We can reduce tax 120 into zero point 0.7, 84 lakhs minus WACC of 10% on the capital employed of 700 lakhs. So this becomes 84 lakhs minus 70 lakhs. This is what EVA is. In a way, this is 14 lakhs. So EVA becomes 14 lakhs. Okay. So EVA becomes 14 lakhs. Yes, very good. Kirti, Satish, your answers are correct. Okay, students. So, yes, so this is done. I'll just wait for 30 seconds. Then we will move on to some of the conceptual understandings. Yes, students. So now let us move to one more concept actually. Sometimes we are often asked around this, what is asset beta? What is equity beta? What is debt beta? What is geared beta? What is ungeared beta, right? So all these things are being asked. So we will just try to discuss that. Okay. So first of all, students, we need to note this one of the equation. This is given in the study material where we are taking from there only. Okay. So Beta of asset portfolio is equal to beta of equity. And here equity proportion we have to calculate equity plus debt 1 minus tax plus beta of debt. Here debt 1 minus tax divided by equity plus debt 1 minus tax. Okay, this is how what we do. Beta of A is equal to ungeared beta, or we say this is the overall asset beta, students. Beta of A is ungeared beta. Why? Because we have taken the impact of debt in this. What is gearing means? Gearing means the presence of debt. Now, if you take the impact of debt back and add it to the beta of equity, you will arrive at ungeared beta. Okay. Beta of E is equal to geared or equity beta, students. Why geared or equity beta? Because the benefit of debt will be reaped by the company, right? So there is a gearing, there is a leverage of debt. What was the leverage of debt? As I told you, you will save tax on your interest that you are paying. So effectively, let's say you are borrowing for 10% and there is a tax rate of 30%. So 7% you end up paying your cash outflow for the purposes of cost of that borrowing, correct? So the 3 lakhs benefits flows to the people who flows to the equity shareholders. That is why we call it as a geared beta. That means there is a presence of benefits on account of debt to the equity holders. Okay. BD, which is beta for debt, is equal to the debt beta. Okay. E is equal to equity amount. By equity, we have already discussed it is share capital plus reserves and surplus. D is equal to debt amount. And all of us know that this debt amount has to be post-tax. So T is equal to tax rate. Okay. So this is beta E. I'm sure you're able to read it out, right? So from above, equity beta is always greater than the asset beta. This is a general outcome, correct? Because in asset beta, because debt beta is always lesser than equity beta, the overall weighted average asset beta will be lesser. However, in one case where beta of debt is equal to 0, then equity beta will be equal to asset beta. What I mean is, sorry, not beta of debt is 0, where debt itself is 0. Okay. Then equity beta will be equal to the asset beta. Because if the company has no leverage on account of debt, then geared or ungeared beta will be same. It will have no benefit. Okay. Plus one more point. In case beta of debt is equal to 0, then beta of asset becomes beta of equity, equity divided by equity plus debt 1 minus tax. Simple. So asset beta will be equal to the equity beta adjusted for the equity proportion in the overall capital, students. Okay, this is the case where BD is equal to zero. The debt beta is equal to zero. Then this is the formation. So this is the first case. This is the second case, and this is the third case. So first case, the general outcome. Shruti, I will explain it again. Okay, let me just take the beta calculations or the beta, understanding again. So first of all, students, there is an overall beta. Okay, overall beta of the assets, right? Which is the asset beta. Now, since WACC, you see overall cost of capital in WACC is an outcome of two things, right? One is the cost of equity and cost of debt, and second is the proportion of debt and proportion of equity. Similar way here also, the beta of equity and beta of debt is taken, and the proportion of equity and proportion of debt post tax is also taken. Now, the overall asset beta is called as ungeared beta or asset beta. The beta of equity itself is called as geared beta or equity beta. Debt beta is again debt beta only. And debt, as we said, that we will always have to take post tax. Now, generally, what happens, the debt beta is always lesser than the equity beta. Okay. And in case it is invested, or let's say in case it is a risk-free security that we're talking about that we have raised through, then it will be zero, right? The debt beta will become zero. So what we are trying to say is that debt beta always is lesser than the equity beta. If that is the case, then the asset beta or the overall beta will always be lesser than the equity beta. Or we can say equity beta will always be higher than the asset beta. However, where in a company the debt is zero, everything is financed through equity. In such a case, equity beta itself becomes the asset beta or the overall beta. Third case, in case where debt beta is zero, right? Wherein let's say the overall amount is let's say funded through riskless securities or the securities which don't carry any risk, then in that case, the equation we have to reduce the part of debt beta and we only need to adjust the equity beta according to the proportion of equity present in the capital structure. Shruti, in WACC also we are taking post-tax, right? In WACC also we are taking post-tax. Here also we are taking post-tax. The only thing is that in WACC we are taking the rate itself as post-tax. Here we are taking the debt amount as post-tax. Okay, Shruti? Mancha, asset beta is called as ungeared beta. That is because you are again taking the impact of debt beta. So if you see the asset beta's definition, this is the geared beta, and within this geared beta, you are removing the impact of gearing that has happened. So in a way, you again come back to the ungeared beta. Okay. Okay, students. Now coming to the next part, market value added. Market value added, which is also called as MVA. Okay, market value added. Now, in case of a market value added, so students, in our previous session, we have discussed about the economic value added. Okay, now let us talk about the market value added. Okay, so again, market value added is not used for the valuation purposes. It cannot be used for the business valuation purposes. It can only be used to evaluate the value of a business. Okay, evaluation is something else and calculation is something else, right? So just like EVA, in EVA also what we do, we try to calculate how much company is able to earn more than the capital charge, right? What is the real value addition from the economic standpoint that is happening? Let's say my capital charge is 80 lakhs. I am able to earn 100 lakhs from the business, right? So net operating profit after tax, why do we take? Because we want to take it from the business angle, right? So similarly, market value added is a calculation from the perspective of how much we are able to value add into our market capitalization. Okay. What extra market cap are we deriving from what we have invested in the business, students? Okay. So Gurram is saying, sorry, coming back to the debt beta is zero, then asset beta equal to equity beta, and your general outcome is become controversy. Yes, Gurram, that is why I have mentioned this is the first case, this is the second case, and this is the third case. All these three cases are different. So this is a specific case where debt value is zero itself, right? And this is a case where the debt beta is zero. If these two things are not happening, then general outcome is your equity beta will be higher than the asset beta. Okay. Shruti, comparing second and third outcome result of both shouldn't be same. No, Shruti, it won't be same. You just put it in the equation and then see when debt is equal to zero, then what will happen? When debt will be zero, then beta of debt will also be zero, because if the proportion itself is zero, or let's say this term will become zero, correct? This debt will become zero, and hence the entire term here will become zero, and here also it will become zero. So it will be beta of equity into equity divided by equity. Simple, right? This is for the first case. Now if your beta for debt is equal to zero, in this case the entire this part also becomes zero, but debt will still be there, right, in the proportion. So both of them will have different outcomes. Okay. Yes, come back, students, here. So market value added, as I was telling, is actually representative of the fact that how much extra your market value is, the company's market value is over and above what has been invested, students. Okay. Perfect. So we will elaborate. We will take ahead the discussion from the concept of EVA, wherein we calculate the invested capital, or let's say the capital employed. So in that capital employed, whatever is the equity value that we compare with the market cap. Market capitalization, which is also called as current market value. Correct? Minus equity amount invested. So whatever is the equity amount invested, this again will include share capital plus reserves and surplus, students. Okay. Now let's say 1,000 crores is the market cap. The as per balance sheet, the equity amount invested is, let's say, 980 crores. So 20 crores at which market is valuing the company higher, that is called as market value added, which is also called as MVA. Okay. Now a fundamental difference between EVA and MVA is what? EVA is actually the periodic comparison. Okay. And MVA is a as on date comparison. Correct. As on date, what is the market value? As on date, what is the equity shareholders funds? In case of EVA, periodically how much you are able to earn and periodically what is your charge, right? So it is okay, students, clear? The difference between EVA and MVA is clear and their utility, the way it is calculated is also clear, students, I hope. If it is clear, then we will move on to the next part. Okay, so EVA is clear, MVA is clear. Then let's come to the SVA, shareholders value analysis. This is called as SVA. Okay, so from a conceptual standpoint, students, shareholders value analysis is what? Okay, I will take you through an example, okay, which will help us to calculate the shareholders value analysis. So if I take the balance sheet, let's say of a company, okay, it will have, let's say, property, plant and equipment. It will have inventories. It will have trade receivables. It will also have the investments. Okay, investments in the form of outside the business, right? Let's say the investment is done in mutual funds. The investment is done in stocks of other companies, right? So this is outside the business, really. Then you will also have, let's say, other current assets which are pertaining to business. Now here, if we see equity will be there, reserves and surplus will be there, then long-term debt or let's say the non-current borrowings, non-current borrowings will be there. Similarly, current liabilities will be there. Okay, that is how a small balance sheet I have actually put it up here. Now, this balance sheet is, we are talking about a textile business. Okay, let's take an example of textile business. The underlying is textile business where the objective or let's say where the primary function of this company, and let's give an example. This is a company, ABC company. Okay, so for this ABC company which is engaged into the textile part is to take the raw material of cotton, convert it into the FG, which is the finished goods of the textile, right, of the bulk textile manufacturing that they do. And this is their current balance sheet that they have, right? So there is a policy, whatever they earn through business, they invest in an investment outside the business. Okay. Now, we have been asked to analyze the shareholders value that is there. Okay, the shareholders value. So step by step, what we will do, the first step, actually we will use the discounted free cash flow method. Okay, so what we will do, we will first of all estimate the free cash flows, right? And here let's take an example of 5 years. Okay, let's take an example of 5 years. So we will estimate for 5 years. After 5 years, terminal value will happen. Because students, I hope all of you remember in my previous session, what I told you is that it's not possible to estimate till perpetuity, right? One, two, three, four, five, and after this, there is a terminal value, right? This period we call as explicit period. Explicit period means specifically for which the estimates have been placed. And beyond this is called as the terminal value. So terminally, what is the value coming out to be? Okay. So I have taken 5 years as explicit period, and terminal value is what will be an outcome later on. So step one for analyzing the shareholders value is to calculate the free cash flows, students. Now, first of all, what do we mean by free cash flows? So I'm just giving a sample calculation here for free cash flows. Okay. So we will start with EBIT. Okay. Earnings before interest and tax. Let's say this is X amount. Then in this, we reduce interest component, right? Becomes EBT. From this, we reduce tax. We come to EAT, earnings after tax, right? Now, this is the profit that we are starting with, correct? These are the profits that we are starting with. In this, we first of all add back the depreciation. Whatever is my depreciation, because depreciation is a non-cash expense. So this depreciation also needs to be post-tax, right? Because earnings after tax is also after tax. So depreciation also will get added post-tax. Or what we can do is in EBIT, we can add tax. In EBIT, we can add depreciation and then arrive at the tax. Okay. So depreciation is non-cash item and hence we are adding it back. Then we also adjust for the incremental capital expense, because for expanding the business in future, we will need certain amount of capital expenditures, right? We will want to invest further in this property, plant and equipment. Correct. For that, we would need more cash flow, which will be used from the cash profits that we are generating year on year, right? If you see, these are the cash profits, right? Roughly, we call them, these are the cash profits, right? Which is earnings after tax adjusted for depreciation. This will be regular depreciation only, students. Please note, this will not be post-tax. Okay, we will cover one question in that it will get cleared. Because there are two ways to take depreciation. Okay, we will cover that in the second half of the today's session. So as of now, you know that whatever depreciation you have reduced from the EBIT, you have to add it back in EAT to arrive at the cash profits, right? These are the cash profits. From that cash profits, you will reap some amount in the capital expenditure. And you will also use that amount for the incremental working capital, because if your business is expanding, you will need higher amounts for working capital. Correct? You will need higher amounts for working capital. So hence, at an overall level, whatever you will arrive at will be called as free cash flow. Free cash flow here will mean that whatever you earned out of the business in the form of cash, from that you reduce whatever is your incremental capital expenditure requirements and whatever is your incremental working capital requirements. Then you will arrive at the free cash flows, right? Perfect. You will arrive at the free cash flows. This is the standard calculation, not only for SVA, shareholder value analysis, but for any free cash flow method also. If you are applying a free cash flow method as well, then you will do the same calculation, students. Okay. Now, once you have calculated the free cash flow for, let's say, year one, year two, year three, year four, and year five, free cash flows have been computed. Okay. Now, these free cash flows are, let's say, whatever we want to take, 100, 120, 140, 150, and then finally 170. These are the free cash flows. And this is again called as explicit period. Students, till now, are you there with me? I hope the understanding is clear. So for explicit period, we have calculated the free cash flows. Then we will multiply it with the present value factor, because year two value is not equal to year one value from a time value of money perspective. So the present value factor will be multiplied in this, and hence we will arrive at the present value factors here, right? And this will be based on the WACC discounting rate. WACC discounting rate. Let's say WACC is 10%. Okay. So 1 by 1.10, 1 by 1.10 raised to the power 2, 1 divided by 1.10 raised to the power 3, and so on, right? This will happen. So you will arrive at the present value by multiplying this present value factor, and let's say the total comes out to be 500. Okay. So explicit period comes out to be 500 rupees. Okay. After multiplying with the present value factors. Understood, students? Now, this is what? This is actually the cumulative present value of whatever your business is going to earn for the next 5 years. And by earning, we are relating to how much we will be able to realize in terms of the cash flow. Because if you read the financials of any company, right, although they might be telling you that they are in profits as per their P&L, but we have to also see the cash flow from operations, whether the cash flow from operations are also getting generated or not. If at one hand we are saying that the company is reporting a profit of 1,000 crores, however, the cash flow from operations is zero, in that case, we have not realized those profits till now. Right? So cash flow from operations and earnings have to go hand in hand, subject to these non-cash adjustments such as depreciation, okay, and such as working capital changes. So we are saying that the present value of whatever amounts that we are going to realize in the next 5 years is 500 rupees. Similarly, for terminal value, we use this formula which is the cash flow of next year end divided by cost of capital minus growth. This will give us the terminal value as on current year. Okay, let me explain. Let's say cash flow of sixth year, if I take and divided by KE minus KC minus G, it will give me the cash flow as on fifth year. As on fifth year end, it will give me the cumulative value. Then from bringing this fifth year to 0th year, I again need to divide it by 1.10 raised to the power 5, right? As a present value factor, students. You're getting my point? This is again very much similar to the capital budgeting decisions that all of you would have understood in your CA inter students, right? You're getting my point? So cash flow of sixth year, if I take and divided by the cost of capital minus growth, it will give me the terminal value as on fifth year end. And again, bringing that fifth year end value to 0th year, I will just again multiply with the present value factor of 10% for 5 years. Okay. Now doing this, let's say the terminal value arrives at, let's say 1,000 rupees. So the total business realization becomes 1,500 students. Okay. This gives us the present value of what business will earn in cash. Okay. For both explicit period and terminal value. Okay. This becomes 1,500 students. Now, do you think that this 1,500 value can we assign to the equity shareholders? Tell me, students, by reading out this balance sheet, tell me what is your understanding or thoughts are, as I've given to you, that the futuristic projections fetches you 1,500 rupees as the business outcome. Now, using this balance sheet, tell me, students, whether I can say that the market value of equity and reserves plus surplus, which is the market value of the equity itself, is 1,500. Is it the right statement I'm putting, students? Tell me. If not, then what I am missing here? We have reached towards the last part of the concept. Hence, I'm telling all of you to please focus. So till now, students, we have arrived at the overall cash flow generation, right, from the business. Can I assign this value to the shareholders, or there is some adjustment I need to do? Guram saying is yes, we can assign it. Okay. Request others also to please tell me. Yes, students. Do you have some thoughts to share? Any other thoughts? So Guram is saying that we can assign it. Can we say that this 1500 is the value of equity shareholders? And that is why the concept of shareholders value analysis. Tell me, or is there some adjustment needed? You just go through this balance sheet. I have given you one fact. I have given you one fact. What is that fact? Some of these investments are outside business. Some of these investments are outside business. That means this 1500 crore. Okay, Satish is saying capitalization rate is required. No, Satish, this is after already including the capitalization because we have taken the 5 years projection, then terminal value. This is the capitalization that we did and arrived at 1000, correct? And hence we arrived at 1500. So capitalization is not the real case. See, now hear me out, students. I have mentioned that outside business, there are some investments. So that means this 1500 crore is a value assigned to PPE, inventory, trade receivable, other current asset, current liability, and non-current borrowings. It is not assigned to investment. Correct? It is not assigned to investments. So what we need to do first of all, from this 1500 rupees, okay, let's say that total present value is 1500. In this, I will add investments, right? Because today the investments amount is outside the business. So if I really want to value this company and this company has invested amounts outside the business, I have to add those investments here. Let's say that is 100 rupees. Further, this value of 1500 is for equity and debt put together. So I have to reduce the debt amount, non-current borrowings. Correct? So let's say it is 50. So it will become 1550. So this is what the shareholders value analysis is. This is value of equity. Now from this we can reduce the book value of equity. Okay. From this we can reduce the book value of equity to arrive at the excessive amount, students. Or let's say we can compare the book value of equity from this value of equity if we don't want to reduce it. Okay. So please do remember, students, this is very crucial part, right? Which we tend to forget. And let me tell you, students, this has a very high amount of utility, that what I'm telling you, because as per the Indian accounting standards, you will have to fair value a lot of things, your CGUs, right? Cash generating units, even brands. So for cash generating units, we always use this analysis to arrive at the right value of equity, which is in this case is 1550, and compare it with the book value of equity. If it is lower, if the value of equity of 1550 is lower than the book value, then impairment needs to be recorded, correct? So this has very good amount of utility in practical life is what I'm trying to say, right? So we have to do these adjustments even in practical life, wherein we will add the investments done outside the business. We will first take what is your underlying business able to fetch, which is 1500. Then in that, we will add the investments outside the business and we will also reduce the non-current borrowings, students. Yes, Gurram. Why? Because in that case, we have taken to compute the corrected cash flow, the ultimate cash flow that you will be able to receive is after reducing the interest, right? And here we are talking from the value perspective. What value will remain for the equity shareholders after reducing the debt and adding the investments? Okay. Now, what insight that we are generating from SVA is SVA is actually forward looking. So students, can we draw a line between these three, EVA, MVA, and SVA? So EVA is historical related numbers. MVA is as on date, and SVA is futuristic, which takes into account what is going to happen in future, right? So it is a forward looking calculation, students. Okay. I hope these concepts are clear, students. One is EVA, MVA, and SVA. These are the three concepts that we have to discuss. Again, these are not relevant. So these are relevant from the evaluation perspective, or let's say analyzing the overall value of the business that we are trying to do. Okay. So there is one more fundamental question to all of you. Okay. Now just think and answer me. So while we talk about the business valuation, okay, so what is the real meaning of business valuation? Is it equity value plus debt value, or only equity value? Business valuation, students, tell me, is it equity plus debt? Do we call it as a business? Or in a, and this I'm talking about a company where both equity and debt is present in the capital structure. Okay. Both equity plus debt is present in capital structure. Tell me, students, this is a very fundamental question. While we talk about business valuation or the business value, do we need to take into account equity value as well as debt value, or only equity value I can calculate and I can say that this is equal to the business valuation? Whatever debt value I'm calculating, I can ignore it for the business valuation perspective. Very, very important thing, students. Okay, very nice. See, now I will get mixed responses. Mansha and Abdul Rahim have given their responses. I will not disclose it. Come on, students, tell me, what do you mean by business valuation? Think it that today I want to go and purchase a company. Okay. I want to go and purchase a company. Okay. Okay. So Satish is also saying oral WAC is used, hence it is both. Prashant, Shruti, I think all of you are saying the same thing. Okay, let me reveal. So all of you are saying it is equity and debt. Bansha, Abdul Rahim, Satish, Gurram, Prashant, and Shruti. I have received responses from all of you, and all of you are saying it is equity and debt. Now, can you go through the formula of asset-based approach, students? What is the formula saying? For valuing the business, what is your net assets value? Fixed assets plus net current assets minus long-term debt. Then we also discussed about income approach, right? In which we arrived at the future maintainable profits, which excluded in the future maintainable profits, we reduced the interest, right? Similarly, in just now discussion that we had, the shareholders value analysis, we have reduced the non-current borrowings. And I was telling you one example. If today I want to go and buy a company, okay, what will I really value there? I will value what is the equity shareholders worth. For that, I will be paying for the business. Because if I take over debt, I will pay for it. If I don't take over debt, I will not pay for it. Simple. So business valuation is actually only your equity valuation, students. Okay, it's not debt valuation. Please think it, because in all these approaches, what you are doing, even in the cash flow based approach, you are ultimately reducing your non-current borrowings, which means that you are trying to achieve the final value of your equity, because ultimately you will pay to the target company the equivalent value of equity that you are able to calculate, because debt is simple. Debt is a liability. So we have taken borrowings and invested into the business, right? With that, we are getting a leverage in our overall cost of capital. We are getting a leverage, right? We are getting some benefit that we will account for in the value of equity, correct? I hope you're getting my point. So business valuation is all about valuing your equity, students, not debt. As I told you, in the asset-based approach also, we reduce long-term debt to arrive at the net assets value, right? Then only you will be able to really value how much your equity shareholders' wealth is invested in the company. Okay, understood? I hope you're getting my point. Satish has said, okay, sir, clear, got it, perfect. Yes, Mancha, even market cap is actually the closing share price into the number of shares. So market cap is from the equity perspective. So today, if I tell you that market cap of a company is 1 lakh of some company, then what will you infer? That the value of the company is 1 lakh. But if you decipher that, then what is the market cap? Market cap is the market value of only equity and any leverage on debt, right? But it will not have the value of debt added into the value of equity to arrive at the market cap. So ultimately, your value of the business will be equal to the equity market cap. And hence the equity value is equal to the equity. And hence the equity value is equal to the business value, students. Okay. Now, Shruti is asking, if we take over a company, we take over equity and debt. I am agreeing. And as I told you in my explanation, that if you take over debt as a part of the takeover, then whatever is the debt amount, for that you will include in the consideration and pay, right? If you're taking over. If you're not taking over, you will reduce the amount and you will pay it accordingly. You're getting my point? No, let's not discuss Shark Tank, Prashant. I don't know how do they calculate, what is their basis, How do they trust on numbers? It's purely, um, I don't have an understanding over there, Prashant. Shruti, yes. So as I told you, equity and debt both, right? So w- that is where the MVA is also emphasizing. So students, if you see, MVA is what? Market value added. So MVA is actually giving you the comparison between the market cap, which is again the value of equity, minus the value of book value of equity invested into the business. Correct? That is what MVA is also telling you. You're getting my point? Even in case of EVA, for no PAT, you're adding back interest. But while doing a capital charge, you are taking WACC. That means you are reducing the interest in EVA to arrive at the final number available for the equity shareholders. Correct? So even in EVA, you end up reducing the interest, right? And SVA, we just now saw non-current borrowings are reduced straight away. So EVA, MVA, SVA, all are from the viewpoint of equity shareholders or the wealth that is getting generated for them students. Okay, clear? I hope the broader concept is clear. Say the consumer wholesaling, then there are some specialty services, then assorted centers. Okay, these are, let's say, three different business segments. You understand segments, right? Segments are those specific, uh, you know, combination of some business elements that gives that operates independently to each other, right? So consumer wholesaling will be operating independent to specialty services, similarly to assorted centers. Okay, so the sales, assets, and income. So if you see any financials, these are also disclosed, right? What is the sales? What is the segment assets? What is the segment income, right? These are also disclosed over there. So this has, let's say these are the numbers that are given: euro 7,50,000, then euro 1 lakh. Specialty services, it's euro 8 lakh, 7 lakh, 1,50,000. And for assorted centers, the sale, or let's say the revenue, is 2 million euros. 3 million euros is the assets, and 6 lakhs is the income. Okay. Now, just like we have beta, right? Or we have a or we have a capitalization rate. So these are reflective of the numbers in relation to market, correct? For example, capitalization rate is 14%. So it means that whatever you earn, if you divide by 14%, you will arrive at the market value. Correct. So just like that, we also have the capitalization rates for these different business segments at a different level. Correct. So in addition to above actual information, we have also been given the capitalization rates, right? So the first one will be capitalization divided by sales, right? Capitalization for assets, and lastly, capitalization rate for income. So if you see, sales, assets, and income are the primarily, are the primary financial indicators for any business segment if we want to evaluate a performance of the same. Okay. So consumer wholesaling, specialty service, and lastly, assorted center, right? So consumer wholesaling capitalization to sales is 0.75, then to assets is 0.60, and to income is 10 times. So again, as I was saying, it's just like P multiple also, right? In P multiple, you multiply the multiple to whatever that base is, let's say to EBITDA, to sales, sometimes to EPS, right? To arrive at the value or the price, right? Specialty service is 1.10, 0.90, and 7 times. And here it is 0.60 and 6 times, right? So this is the capitalization rate that is given. Now, why are we, dealing with this? Because the chop short method says that you have to arrive at the individual values. Okay, you have to arrive at the individual values for these business segments at sales level, at assets level, and even at the income level, right? And then all these three levels. So for example, basis sales, you come to know that there is X value, basis assets, it's Y value, and basis income, it's Z value for the company put together, for all the three business segments put together. Now you have to take an average of all these three to arrive at the overall company's value. We will calculate that so as to arrive at the overall value, students. Okay. Sorry. Okay, now this is what it is given. Now let's do the solution using Okay. Now in this case, first of all, we will say for the sales related data, right? We have consumer wholesaling, then specialty services, then assorted centers, right? So capitalization to sales ratio was how much? That was given 0.75, 1.1, and 1, right? 0.75, 1.10, and 10. Segment sales. How much sales has been reported? 15 lakh, 8 lakh, and 20 lakhs, right? Okay. Then the theoretical value becomes how much? Theoretical value, we have to multiply this into 15 lakh, right? This becomes 11 lakh 25,000 students. This becomes 8 lakh 80,000. Then this becomes into 1 is 20 lakhs itself. So this is 40 lakh 5,000 euros. Okay. This is basis sales, right? Similarly, students, we will have to do basis assets now. Specialty services and assorted centers. This will be capitalization to assets, right? What is the zero? What is the ratio given? 0.60, 90, and 60, right? What is the asset base? Asset base is 7.5, 7, and 30. Okay. So this becomes how much? This becomes 4 lakh 50. This is again theoretical value, right? So 0.60 into 7 lakh 50,000 becomes 4 lakh 50,000. Next one becomes 6 lakhs 30,000. And the last one becomes 18 lakhs. So the overall becomes 28 lakh 80,000 students, right? So this is the total value, right? And the last valuation will be basis the income, right? So here we have consumer wholesaling again, specialty service, and then we have assorted center. This will be capital to income, and then theoretical value, right? Capital to income. is how much? 10 times, 7 times, and 6 times. Okay. And the segment income is how much? 1 lakh, 1,50,000 and 6 lakhs. 1,50,000 and 6 lakhs. This becomes 10 lakhs, 10 lakh 50,000, and this becomes 36 lakhs. This becomes 56 lakh 50,000. This becomes total value of this much, right? So the average theoretical value. Now under the chop shop method, we have calculated the values coming on account of different parameters, right? One basis sales, one basis assets, and third basis income. Now all these three values we have to average out. So average theoretical value will be 40 lakh 5,000 plus 28 lakh 80,000 plus 56 lakh 50,000 whole divided by 3, right? So this becomes 417,833. Value of the business is this much. Okay. Understood chop shop method. It's more to do with how you project your internal numbers in relation to market, multiplying that multiple, right, for these different business segments, arriving at different valuation and taking a average out numbers basis the same students. Okay, students. Clear? Shall we move ahead? So students, we will pick up one more question from study material, then we will follow our balance questions. So from study material, let's take one more question so that we practice well. And let's take this question number, I think 8. Okay. So please go through the question from study material students and we will do the solution and I will explain you some of the tricky parts in this question. Okay. Perfect. So we are taking study material. So the reason why I've taken it separately because this has some level of discussion involved. That's why I'm taking it first and then we will go to the balance questions. Study material, question number 8 from practice questions. Okay, very, very interesting question on the cash flow, discounted free cash flows. Okay. So students, I'm reading out that question from the study material. Okay. So we have been given some of the information in the respect of WXY Limited, and they are saying that it is expected to grow 20% for the next 3 years, and after which the growth will become 8%. Okay. And that 8% growth will become in perpetuity. So 20% growth for explicit period, which is 3 years, and 8% for perpetual growth. Then they have given us some of the estimates on revenues, COGS, operating expenses, capital expenditure, and depreciation. Okay. Depreciation, they are saying that they have included in the operating expenses. However, they have given us separately. During high growth period, the revenues and EBIT will grow at 20%. So what they are saying is revenue minus COGS minus operating expenses will grow at 20%. And CapEx, capital expenditure minus depreciation will grow at 15%. This is again for the explicit period. And terminal value will be at 8% growth. Okay. Further, terminal value from year 4 onwards, and then yeah. Further, what will happen? CapEx will be offset by depreciation, so that CapEx minus depreciation is 0. So this is called as maintainable CapEx, students. This is what I'm trying to say. So let's say what we do, whatever we depreciate, we keep on adding the capital items into our portfolio. That is called as maintainable capex, because we are not expanding as such, we are just maintaining our capex. For an example, let's say you have purchased laptops in a company and those laptops have useful life of 3 years. So after every 3 years some amount has to be replaced, right? Some amount of laptops have to be replaced, so that is called as maintainable capex. So you will keep on depreciating and you will keep on replacing, so that continues as a cycle. Okay. And they have given us WAC, income tax, and they've also asked us to calculate the value of WXY Limited using the free cash flow method and WAC methodology both, right? Okay, students. I hope all of you have questions in front of you. So first of all, students, for solving this, we have to actually calculate what is the free cash flows arriving, right? So calculation of free cash flows. So just today itself, we have understood the concept of free cash flow, students. Free cash flows is what? Free cash flows are actually, using the operating cash flows after tax, adjusted for depreciation, minus capex and incremental working capital requirements. Okay. So let's start with year 1, year 2, year 3, and then finally the terminal value related computations. So revenue, students, revenue was given us as 7,500, but that was given for the current year. Okay, the year which has passed. So for the next year, the revenue will increase by 20%. So that means year 1, it will become 9,000 into 1.20. Okay. Then 9,000 will become another 20%, which is 10,800. Correct? And year 3 again, it will grow by another 20%. So it will become 12,960. Right? And terminal year, it will grow by 8%. So it will become 13,996.80. Clear, students? Revenue is clear. Then let's come to COGS. Even COGS also will grow with the same. So current COGS is how much? I think 3,000. Yes. So 3,000 will grow to 3,600 in year 1. 3,600 will grow to 4320 in year 2. Then it will grow to 5184 in year 3. And finally, it will grow by 8%. So 5598.72 for terminal value. 5598.72. And just to tell you students, for this terminal value, this is the year 4 values that are getting computed. Okay. These are the year 4 values, year 4 end values that are getting computed. Operating expenses. Now, since operating expenses included depreciation, okay, what we are doing is we are separately calling out the depreciation here and operating expenses here. Okay. Now, what were operating expenses in totality? Operating expenses were 20 to 50. From that, we are reducing depreciation of 600. So it becomes 1650 into 1.20, 1980. Again, this will be plus 20%, which is 2376. Again, this will be plus 20%, which is 2851 plus 20. And this will be 8% in the terminal value year 4, which is 3079.30 students. So Kusuma is saying first year COGS is 3000. I am also saying that it's not first year, it's the current year. So to arrive at the first year, you will have to take a 20% increase on the current estimates. Okay. Just like revenue also we started, COGS also we started, operating expense also we started, depreciation also, the same treatment needs to be given. So 600 was the depreciation. On that 20% if we do comes out to be 720. Further 720 plus another 20% is 864 students. Right? Plus another 20% for year 3, explicit year 3 is 1036.80. Then finally plus 8%, which is 1119.74. Okay. So we have considered revenue, we have considered COGS, operating expense, and depreciation. If we reduce from revenue all these three items, COGS, operating expense, and depreciation, we will reach to EBIT. So this becomes 2700. This becomes 3240. This becomes 3888. And finally, this becomes 4199.04. Okay, so this is clear, students. Then there is no interest that has been told to us. We will just take tax at the rate 30%. Correct. So it will be 810, 972, 1166.40, and finally 1259.71. No, Guram, depreciation will also grow because the question has mentioned is specific. See, depreciation will also grow, right? Once you invest more capex, you expand, so the depreciation will grow. And further, the question has also told that everything till EBIT will grow at 20%. Okay, hence we have taken. Okay, Jyoti is saying net of capital expense and depreciation grows at 15%. So Jyoti, the question is saying capex minus depreciation is growing at 15%. However, depreciation itself is growing at 20%. You read again, Jyoti. Okay. So the question is saying that the capex minus depreciation is growing by 15%. We will come to that once we arrive at the EAT after this. I will explain you that too. Earnings after tax. Right. So it becomes 1890, 2268, 2721.60, 2939.33. Correct? This is earnings after tax, students. Is earnings after tax. Now, next point comes capital expense minus depreciation, right? In the current year, how much it is? In the current year, see the depreciation included in OPEX is 600 and the capital expenditure is 750. So 750 minus 600 minus 600. This is for year one multiplied by 1.15. Correct, students? So this becomes 172.50. Again, 172.50 plus 15% for the next year. This becomes 198.38 plus another 15% comes out to be 228.13. And for the TVG terminal value, it has been told to us that the capex is equal to the depreciation. So capex will get offset by depreciation. Simple. So this gives us the adjustment for capital expenditure to be done in earnings after tax. So students, some of you might be thinking that why are we doing capex minus depreciation? It's because of the simple reason. So from EAT, we will reduce this. Okay, if you let's say assume this is 1 and this entire number is 2. So we will be doing 1 minus 2. The moment you do 1 minus 2, you are doing EAT minus capex minus depreciation, right? As per our earlier formula, what we have to do, EAT minus capex plus depreciation, right? If I open this. So ultimately, we are treating the same result. For calculating the free cash flow, we are reducing the capex, adding back the depreciation to arrive at the free cash flow. I hope this is clear, students, okay? And since the question, the way it is drafted for the terminal value, it is saying that the capex will be equal to depreciation. Hence, we have taken it like this. Now, let's come to the change in working capital. How can we calculate the change in working capital? Okay, let's take the revenue. Revenue is 9,000 into 25% is what the working capital we have to maintain on revenue, right? That is what is given in the question. 25% of the revenue, right? Minus 7,500 into 25%. So this becomes 375 students for the year one, right? For year two, similarly, this is year one. Year two, what is the revenue reached out at? 10,800 into 25% minus 9,000 into 25%. 10,800 into 0.25, 9,000 into 0.25, 450, right? Sorry, this is the year three. I think I have kept it. This is actually 450. So this is year one. This is year two, right? Similarly, for year three, this will be how much? Revenue is 12,960. 10,800 into 25%, correct? So students, we have to take the movement. We have to take the movement of the changes in the working capital, right? So this becomes how much? This becomes from 450 to 540. right? And then for finally for the TVG, right? Terminal value, this will from EAT. So finally we are doing EAT minus capex minus depreciation minus change in working capital, students, right? So if we do that, then we will arrive at the free cash flow. So for year 1, 2, 3 and terminal value, we arrive at 1342.50, 1619.62, 1953.47, 2680.13, 2680.13. No, Guram, capex is not zero for terminal value. Capex is equal to the depreciation of the terminal value. Okay, there is a difference in both the things. Okay, let's move ahead, students. So now let's come to the present value factor, right? So for year 1, how much it is? 0.8696. That is given in the question, right? Then for year 2 is 0.7561. Year 3, how much it is? 0.6575. As of now, let's do only for the explicit period, because terminal value, we have to calculate the value first. Then we have to arrive at the present value, okay? Because the terminal value is the 4th year cash flows that we have computed here, right? So from 4th year, first we have to arrive at the 3rd year value. Then 3rd year value, we have to do the present value, okay? So this becomes 1167.44. This becomes 1224.59, and it becomes 1284.41. Okay. So that total, I am writing it here, 3676. This is the explicit period. Now let's come to the terminal value. So terminal value, what is the cash flow? What is the free cash flow? 2680.13 divided by what is the WACC? 15% minus what is the long-term growth? 8%. Correct, students? So this will give us the value as on 3rd year end. Correct, students? This will give us the value as on 3rd year end. True? Now, value as on 0th year will be 2680.13 divided by 0.15 minus 0.08 into 1.15 raised to the power 3. Correct? This will give us the value as on today, that we have to do the present value. Okay. Then the terminal value, present value comes out to be 25174, 4.08 crores, right? Explicit period also, this was crores, right? So the value of the firm is equal to 25174.08 crore plus 3676.44 crores. So the total amount comes out to be 28850.52 crores, students. I hope this is understood and clear. So ultimately, the catch here is one, how to calculate free cash flow, students. That we have understood basis this practical question, right? Second thing that is very much important is the treatment of capital expenditure and depreciation in the explicit period as well as in the terminal value. Plus one more thing, terminal value, if we have the next year's number, then the terminal value gets calculated as on today by the formula of free cash flow divided by cost of capital minus growth. And that value has again to be present valued to arrive at the today's value. Okay. Yes, Jyoti, you are right. Perfect. Let's move ahead, students, to question number 11. Okay, let me put this. I think people are saying they have to note it down. Perfect. I hope this is clear. Now let's come to question number 11, students. Now, question number 11 says that Tender Limited has earned a net profit of rupees 15 lakhs after the tax at 30%. So 15 lakhs is the net profit and tax is at 30%, students. Interest cost charged by the financial institutions was 10 lakhs. Now see, students, they have given us the interest cost in absolute amount, right, of 10 lakhs. The invested capital is 95 lakhs, out of which 55% is debt and 45% will be equity then, correct? Because if 55% is debt, balance will be equity. The company maintains a weighted average cost of capital of 13%. So WACC they have given us as 13%. Required, compute the operating income. What do we mean by the operating income? Which is adjusted for interest, students, right? Which is the NOPAT, net operating profit after tax, correct? So let's start. We have been given a taxable income of, let's say, 15 lakhs, right? Okay, let's start like this from whatever is given in the question. Net profits is equal to 15 lakhs plus tax. Tax is 15 lakhs divided by 1 minus 0.30 into 0.30. 642, 857. 6.42 lakhs. In a way, I will say, okay. So the total profit before tax comes out to be 21.42 lakhs, correct? So this is our PBT, students. In this, we have to add interest. Okay, we have to add interest to arrive at the operating income. Interest was how much? 10 lakhs. So the total amount is 31.42 lakhs, correct? What is EVA then? So this I can say PBIT, correct? This is operating income. Now, since the question is silent on whether to calculate post-tax or pre-tax, we can keep it as any which ways, right? We can keep it as post-tax also or pre-tax also, right? So the operating income is 31.42 lakhs. Then second part, compute the EVA, economic value added. So for calculating EVA, we have to make use of, okay, let's write PBIT minus tax simply. One minus tax, right? Minus capital charge, right? So this will be 31.42, 1 minus 0.30, right? That is the 30% tax rate minus 13% is already given as the WACC, right? Into capital invested is how much? 95 lakhs, right? So even this split is not used as of now. You're getting my point? This split is also not used as of now. So the economic value added becomes 3142, 31.42 minus 30%. That is as good as 22 lakhs minus 95 lakhs into 13%. So this is 12 lakh 35,000. This is equal to 9 lakh 65,000. So EVA becomes 9 lakh 65,000. Okay. Clear, students? Yes, Jyoti, you're right. 9.64 lakhs. Now, I think the last part, tender limited has 6 lakhs equity shares outstanding. How much dividend can the company pay before the value of the entity starts declining? So they are saying that the equity shares outstanding are 6 lakhs. Now we have to understand that how much extra dividend we can pay so that the declining does not happen. That is indicated by EVA, because EVA is helping you to let you know that extra amount you're earning over and above the expectation is 9 lakh 64 or 65,000, right? This is what you're earning as EVA. Now, the moment you pay anything over and above 9 lakh 65,000, you will end up declining. Reason being, in the next year, you will be operating with lower capital and hence lower growth, because growth, we have discussed that growth is the return on investment multiplied by the amount retained. Okay, so if higher you pay dividend, lower will be your future earning capacity. So up to the amount of 9,65,000 is what you can pay as dividend. Okay. So EVA dividend will be 9,65,000 divided by 6 lakhs shares, right? So 1.6083 per share. So the maximum dividend that we can pay before our value of the firm starts declining is 1.6083 per share, students. Okay. Let's move to question number 12 quickly. Question number 12. Herbal Gyan is a small but profitable producer of beauty cosmetics using the plant aloe vera. This is not a high-tech business, but Herbal's earnings have averaged around 12 lakhs after tax, largely on the strength of its patented beauty cream for removing the pimples. So what they are saying is that there is a one flagship product, which is a patented beauty cream for removing the pimples, which have 12 lakhs after tax kind of a earnings that has been contributed in this business. Okay, fine. The patent has 8 years to run, and Herbal has been offered 40 lakhs for the patent rights. Now, since there is a value assigned to the patent, right? Because patent will protect their rights to continue to sell and take an advantage of the cash flows in future. The present value of that is around 40 lakhs, right? Which will continue for the 8 years, students. Herbal's assets include 20 lakhs of working capital and 80 lakhs of property, plant, and equipment. So what they're saying is, as of now, only 100 lakhs is included. They have not included this unrealized or unrecognized 40 lakhs for the patents. The patent is not shown on the Herbal books. That is what we have just now discussed, right? Because the facts of the questions is that they have not included it in the Herbal's books. Suppose Herbal's cost of capital is 15%. What is EVA? Now they're asking us that if cost of capital is 15%, what is EVA? Now for calculating EVA, we need net operating profit after tax, and we need WACC, and we need capital employed. So I think two things here are straight away given to you. One is the operating profits, and second one is the WACC. The only thing which we have to discuss and understand is on the capital employed. Now, students, if you note that the capital employed is definitely from our one of the previous question that we understood, we use the weights, or let's say the value from the market perspective. As I'm telling, what is capital charge in EVA? The capital charge is the expectation from investors side, right? Be it equity holder, be it debt holder, they will have some level of expectation, and that expectation is on the current market value, or let's say the current, not on the book value, students. It's on the current adjusted book value, right? So we will have to take into account this extra asset of 40 lakhs that has not been created yet. Okay. So let's calculate, students. EVA will be equal to, again, we will just write the formula. Let me write operating income after tax minus cost of capital, which is WACC multiplied by the investments. Okay. This is what will be. Now, calculation of total investments. So students, total investments, how they will be calculated. First of all, we will understand what is the working capital. How much is the working capital? 20 lakhs, right? This is easily recorded. This is already recorded in the. Yes, Viraj, WACC is cost of capital. It's same. Cost of capital, WACC, overall cost of capital, it's all one and the same thing, okay? Working capital is 20 lakhs. Property, plant and equipment is also 80 lakhs. Plus, we will also need to include the patent rights of 40 lakhs, because the investors will expect the capital charge, not only what is the current book value, but also on the value, including any adjustments which seems from a futuristic perspective, which is this 40 lakhs, because This will be used for another 8 years, and another 8 years, the value that we can derive out of it is 40 lakhs, which is the present value, right? So this becomes 140 lakhs, correct? So the capital employed is this much. Now coming back to EVA, what was the number of operating profit? 12 lakhs after tax. Since now no distinction has been given and no additional fact is given, so we will just take 12 lakhs minus, what is the cost of capital? 15% into 140 lakhs. Okay. So 12 lakhs minus 140 into 0.15, 21 lakhs. So this is the first question, students, till now, where we have got the EVA as negative. That means we are 40 into 0.15. If I do, it becomes 6. Still, it was negative. Even if we don't adjust for the patent rights, even if the shareholders don't demand their capital charge on the patent rights, still they will have a shortfall of EVA. So in a way, what we can say is that the business performance evaluation on account of EVA states that it is throwing up a negative number. So either we need to optimize our capital structure or we need to generate more income to meet the expectation of the investors. Okay. So these are the action points that comes out. Any questions, students, till now? Any questions till now, students? Please do let me know. I'll just pause for 30 minutes, sorry, 30 seconds to check and see if there is some question or some query that is there. Then we will move to the next question. So EVA negative means that we have to increase our operating profits or we have to optimize our capital structure so as to reduce the capital charge. Shailesh is saying clear, sir. Okay. Rest everyone also, please do let me know in case something else is pending to be discussed, because now only 2 questions are left. That's all. Okay. Let's go to question number 13. Constant engineering. We also one of the good question again on EVA. Constant engineering has developed a high-tech product which has reduced the carbon emissions from the burning of the fossil fuel. Okay. So they are into some of the development of some product which has led to the lower carbon emissions from the burning of fossil fuel. The product is in high demand. It will be, right, because of all the climate changes that are happening, the product will be demanded high. The product has been patented and has a market value of rupees 100 crore, which is not recorded in the books. So there is a patent that has been done and there is a market value of this patent. Now, students, if you see, for valuing these, right, for valuing these, so this is also a separate valuation, correct? See, we are talking about the business valuations here, right? But within the business, these patents are also underlying. So how do we value these patents, right? So there are different approaches for that too. So one of the method that is used is relief from royalty method. So in this case, what we do, we take future projections of revenue, let's say 5 years, and then terminal value, and multiply it with the royalty rates. You're getting my point. So we multiply it with the royalty rates to arrive at the value. So it might have been achieved. 100 crore might have been achieved using that. The net worth of the Constant Engineering Limited is 200 crore. So this is the net worth. Now, students, again, an important point to understand. Net worth, does it includes debt plus equity, or net worth is only equity? Come on, students, tell me. Net worth, is it again debt plus equity or only equity? Lot of people has confusion over here. What do you mean by net worth? Don't read later on, otherwise you will get a hint. But till now, tell me whether net worth is a debt plus equity or only equity. Yes, very good. Jyoti, Prashant, Shailesh. Perfect. It's only equity. So don't confuse that net worth is equity plus debt. Okay. So net worth is 200 crore, long term debt is 400 crore. The product generates a revenue of 84 crore. Okay. The rate on 365 days government bond is 10% per annum. They have given us a risk free rate, or let's say the cost of debt. The market portfolio gives a return of 12% per annum. Okay, that is also understood. The stock of the company moves in tandem with the market. So what they're saying is that the market portfolio return of 12% is as good as the company's return. Okay, that means cost of equity we can take as 12%. Cost of debt is given as 10%. Okay, calculate the EVA of the company. Simple. Now, the catch here is that in this case, the EVA calculation, we have not been given overall cost of capital. We have to calculate the WACC using the overall cost of capital. So let's start, students. Solution. Net worth was how much? 200, right? This is rupees in crores. Long term debts is how much? 400 crores. Then we also have patent rights, which were unrecorded, right? Those are 100. So 700. This is the total, students. Total capital employed. Now tell me, students, what is the value? What is the breakup of this 700 into equity and debt? Because finally we have to bifurcate this value into equity and debt, right? We have to finally allocate the value to equity and debt. Tell me, out of the 700, what is the value of equity and what is the value of debt for calculating the WACC? And this is the main part of the question. Okay, if you are able to understand this, then I think we are through. So for calculating the WACC, or let's say the capital charge, we have to calculate the difference, right? To bifurcate equity and debt, okay, Jyoti has given one answer. So Jyoti is correct. So that answer is correct from Jyoti's side. I request everyone else also to please think and put it. What is your thought on the same? Yes, only Jyoti has replied. I request everyone all else also to reply once. Mansha, you are right. Shailesh, please recheck. Rest, yeah, students. So, equity and debt, students. equity will be 200 plus 100 and debt is 400 students. So it becomes 300 is to 400. Okay. This is the ratio students. Now let's go back. Overall cost of capital will be equity. Sorry, cost of equity. Let's put it like this. Cost of equity multiplied by earnings. Sorry, equity divided by equity plus debt plus cost of debt multiplied by debt divided by equity plus debt. Okay. So in this case, have we given anywhere the breakup of tax? No, right? We have not been given what is the tax rate. Hence, we can ignore it. So simply overall cost of capital will become cost of equity was how much? 12%. Because it was mentioned in the question that market return is 12% and the equity return is as good as market return of the company, right? So we can take it as 12% into 300 divided by 700 plus debt is 10% into 400 divided by 700 students. So this becomes 0.12 into 300 divided, sorry, 0.12 into 50 divided by 7. 5.14% plus 10 into 4 divided by 7. 5.71%. So the total becomes 10.85% students. Okay. So the EVA now, can we go back to EVA? Okay, let's put EVA formula. EVA is equal to profits earned, which is again the operating profit, needless to say, back into invested capital. Okay. So 84 crores is the amount. Carbon emission, the granted 100 crore, net value 400 generates a revenue of 84 crore. Actually, if you see, it's not the profit, it's actually the revenue that the question has mentioned, but we don't have any other direction to arrive from that revenue to profit. Hence, we will use the same number. Okay. 84 crore minus WACC of 10.85 percentage multiplied by the invested capital of 700 crore. Right. So 10.85 into 7, it comes as 75.4 crore minus 75.95 crores minus 84, it comes as 8.05 crores. Okay. So EVA is equal to 8.05 CR. Clear, students? I hope the understanding is clear. And in case of different scenarios, we are also able to make it out. How do we need to adjust, right? We will go to the last question now, students. So the last question is question number 14. Okay. Students, is there any other query? I cannot see on the query box. If there are some other queries, please do let me know. Yes. Question number 14, students. The following data pertains to XYZ Inc. engaged in the software consultancy business as on 31st of December 2010. This is as on date, that data. These are the information. So income from consultancy they have given, and this is dollars in million. Okay. Income from consultancy $935 million. EBIT on this is $180 million. Interest on loan comes out to 18, right? EBT then 162. Tax they have reduced to arrive at 105.30. Balance sheet. They have equity stock of 10 million shares into 10 each. They have reserves and surplus. They have a loan value also that is running. Current liabilities, and here they have PPEs, and then the current operating assets, which is debtors, cash, and bank. With the above information and following assumptions, you are required to compute EVA and MVA both, right? So this is the first question on MVA that we are doing, market value added. And the assumption that they're asking us, don't go with this split. You just take a WACC of 12%. That is easy. And the market price of the share that are currently being quoted as $50 each. Easy, students? Correct. So we have to first compute the economic value added, right? So let's start. Economic value added. We have EBIT. Let's start from earnings before interest and tax. 180. This is dollar millions, right? 180 is the EBIT. Now, operating profit, students, do we need to reduce interest? No, right? We just take for the purposes of EVA, EBIT minus taxes at the rate of, what is the tax rate, students? 35%. So 180 into 0.35 comes out to $63 million, right? So this becomes 117 as net operating profits after tax. Okay. Now, now we have to compute the capital employed, students, right? Calculation of capital charge, I mean to say, right? Let's compute the capital charge, right? For using the capital, for calculating the capital charge, we need to first calculate the capital employed. So how do we calculate capital employed? First of all, equity, how much from the balance sheet? 100. Reserves and surplus is how much? 325. Then there is a loan as well that is there in the balance sheet, 180. So this becomes 100 plus 180 plus 325, 605. This is again dollars in million. So 605 is what the value is. That is for the capital employed. Now, From this, we have to adjust for the WAC to apply for the capital charge. WAC is already given at the rate of 12%. So 605 into 12%. So that is 72.60. So student, this is how it is calculated. 605 into 44.40, right? So hence EVA will become $44.40 millions, right? Clear? Is clear, students? EVA is clear. Let's go to MVA now, market value added. So for calculating MVA, students, what we discussed today, we have to calculate the market value minus the invested amount. Correct? That will give you the incremental amount that market is assigning to the company. Yes, Jyoti, very good. Your answers are correct. Now, let's first compute the, for market value added, we have to compute the market value of equity, right? Now, somewhere in the question, it was given to us that the share of the company is currently traded at $50 and there are 10 million shares, right? So can we calculate the market value basis this? Yes. So 10 million shares multiplied by $50 per share. Again, this we are calculating in dollars million. So this comes as $500 million. This is the market value. Now, equity fund has to be reduced. This is the book value of the equity fund, right? For this, again, what all we will take? Equity stock and reserves and surplus, right? 100 plus 325. And students, important point to note here is that we are not reducing, or we are not, for calculating market value added, we are not adjusting anything on account of debt, right? So this again signifies the earlier principle that the valuation is done for equity. Okay. Or let's say the MVA focuses on the equity amount. So equity fund will be share capital of 100 million, then reserves and surplus of 325 million. Total is 425, right? So the MVA, market value added, becomes 75. So MVA is 75, EVA is 44.40. Yes, perfect. So that is all, students. If you see EVA, it's a period or it's a historical amount. MVA is as on date amount from the market perspective, students. Okay. So students, is there something that is left? Please do let me know on the query side, because we have covered broadly the topic. So I'll just pause for 30 seconds and wait if there's something else. Otherwise, okay. So I think that's it from my side. I request C. Ashish sir, who is there with us, to conclude the session. Thank you, sir. Hello. Sir, I believe the voice is not audible. Sorry, Ashok ji, should I close my PPT? Okay, okay, okay.
Am I audible now?
Yes, sir, you're audible now.
Thank you then.
It's audible.
Okay, thank you. Now, video, video, video transfer. One second. Okay. Student, with this, we come to the end of this topic of business valuation. Now, in the overall session, you have seen that, one second, student. Overall, you have seen that uh, the business valuation is, of course, it is some methods are involved. But remember one thing, this valuation is also, you can say, is a perception based, because because whenever we evaluate the valuation, it may be possible that two person may have a different perspective, and accordingly they may have a different perception. Now, in a query session, some students were discussing like valuation as per Shark Tank, etc. Now, student, please note that basically startup valuation, of course, we have given some methods are there, but as per once upon a time, I have some discussion with one investment banker, and I asked, sir, is there any specific model for business like startup valuation? So his reply was that the dynamics of the valuation of startups are their valuation is very dynamic in nature. So everyone investor has, or any venture capitalist has their own model. So we cannot generalize, like we have discussed EVA, growth model, whatever with the model we were discussing, they are generally applied for a stable business, or they was applied for traditional type of business. When we talk about the startups, normally their nitty-gritties are totally different, because we have seen here, we are watching cash flow after tax, free cash flow to the firm, free cash flow to the equity, chop shop method. All methods are basically involve the profits. Okay, from profit we are driving cash flow. But in startups, if you see, there are no such profits. Rather, it's just starting with the losses. So that on that basis, if we start computing the value, then we cannot value it. So basically, valuation of the startup is quite a dynamic in nature. So we cannot apply any model. Of course, perceptions are always there. So student, with this, but in examination, whatever the facts are there, whatever the method we have discussed, you have to follow the same. With this, we come to the end of the session. Now, student, there may be some slight change in the schedule. Okay, so my request to you, just you by the evening, we will be there. There may be some change. If there is some changes, you just make note of the same, and accordingly attend the class for the next topic. Okay, Devas, thanks a lot for your
Thanks.
spending your precious time and throwing the light on the student on this business valuation topic for the student.
Thank
And student, thanks a lot to you also for listening patiently the lecture and responding in a very interactive manner. Thanks a lot. Have a
Thank you,
nice
sir.
day.
Have a nice day. Thank you.